Well, let's get to a conversation about dividend payments and those investors who are seeking yield outside of the banking sector. For that, let's bring in James Gerrish from Shaw and Partners and also author of Market Matters, who's standing by. James, welcome back. It's great to go see you there. We've got bank dividends about to get paid across many people's bank accounts at the moment. If you want to reinvest that back in the market as an income investor, what are some of the options that exist outside of the financial industry?
G'day, Scotty. Good to be speaking with you again. Yeah, I thought this morning we'd focus on a couple of dividend stocks that we like, which are outside of the banks. Obviously, the banks have three of the big four are paying dividends in the next little while, but they've had a good run as well. So if you're recycling some of that capital outside, three names I'd look at would be Metcash, MTS, Transurban, TCL. And I'd also look at a AGL, which is a little bit more of a situational play, but it's going to give you probably 5% yield over the next 12 months and some upside in terms of corporate appeal, etc. So three names that happy to go through there with you.
Mate, can we kick off with the AGL Energy story? Because that's a really interesting one. And the other two are quite defensive in nature. AGL, though, we know that it's had a lot of weakness in the share price in particular, and a lot of concern about what its earnings may look like moving forward. But it's one of those companies as well that's undergoing a pivot of sorts towards a clean and green future. When you look at it as a situational play, as you describe it, can you feel comfortable as an investor that you can go and get that income stream but not lose it in capital return?
Yeah, it all comes down to the price that you pay for it, Scuddy. So obviously the share price, 12 months ago was very weak, and then it ran up to just shy of $9, and it's now come back into the mid sixes and has rallied in the last couple of weeks to be just above 7%, as the viewers can see on the chart there on your screen. It's not so much about the earnings side. So the earnings, you rightly point out that earnings are going to be, they're a little bit hard to put your handle on in the short term, and the company guidance is reflective of that. But the underlying, you can get a better flavour for the value of the underlying assets, and this is what a number of large private equity players, infrastructure investors, and Grok has come out and determined. So I think from an asset play, it's interesting. I think the register implies that something is going to happen from a corporate level. And I think the dividend, given the earnings that we know of, or the baseline earnings that we can predict, the dividend is safe as well. So to me, it's got some upside in terms of share price, as well as paying a reasonable dividend while we wait for that to play out.
Okay, something for everyone when it comes to AGL. Let's go and talk about Transurban. We know that obviously toll road operator has the ability to go and link a lot of toll increases to inflation as well. We know what inflation is doing around at the moment. Give us a sense as to what it's paying at the moment when it comes to dividend yields and why you like it as an alternative.
Yeah, you sort of look at Transurban and think it's obviously a defensive infrastructure style business. It is, it carries a fair amount of debt, which may not necessarily be a great thing in rising interest rates, but the offset is around their revenue being linked to inflation, as you rightly point out. The other thing I think that's underestimated or underappreciated from the market is the growth over the next 5 years. So they've got a couple of new projects coming on stream. Stage 2 of West Connects, the North Connects. They've got some assets that are rebounding from weak COVID trading. So if I look out over the next 5 years, there's Transurban on consensus numbers has got compound annual growth rates of around 8.5%. So you're going to get that 4% dividend yield, quickly turns into something like 5.5%. And continues to grow from there. So if you think about irreplaceable assets, a defensive earnings stream that's got some growth, then Transurban certainly fits that bill, and also obviously linked to CPI, as you made mention of.
All right, mate, let's go finish off. Metcash, grocer, also a wholesaler primarily. What do you like about it at the moment, and why do you think that dividend is stable when it comes to the yield?
Yeah, if you're looking for something that's going to pay an upcoming dividend, so they report in December and go ex-dividend before Christmas. So from a timing point of view, it stacks up. They're cheap for the type of earnings that they're delivering, but also you want growth in earnings going forward. So their hardware division, each time they report, is becoming a greater proportion of their overall earnings base, and because it's growing quicker than their underlying business, over time they should be getting should be trading on an incrementally higher multiple. So, Metcash trades on about 13 times. Wesfarmers, which has Bunnings making up about 60% of its earnings, trades on 21 times or thereabouts. So obviously as growth starts to come through for Metcash, more aligned with what Wesfarmers is seeing through Bunnings, then the multiple should go up as well. So, and you get paid a 6% dividend on the way through. So if you're thinking about portfolios, you want defensive earnings, you want some growth in those earnings, you want reasonable valuations, and you want a strong yield while you wait for those, your investment thesis to play out.
Mate, with a company like Metcash, as an inflation hedge, do you like it as that kind of role as well?
Yeah, it fits that bill. So you want, if you think about your local IGA, in which Metcash is a wholesaler into, price is not as, price is not a huge, not as much of a determinant there. It's more about convenience. So, and that also fits into the growing theme around online shopping and the like. So everyone's ordering their groceries online, but they then need to stop off and fill up during the week, and convenience has been a beneficiary of that. So I think the trends in that business are quite strong, and they've done a really credible job in the last 18 months, 2 years in this business under a new CEO in the latter part of that. So to me, it stacks up. It's in our income portfolio along with the other two stocks, and we see higher levels from here.